Welcome again to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 focus points, highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll look at the Producer Price Index data. In point number 3, we'll look at the CPI or Consumer Price Index data. And in point number 4, we'll look at the National Associations of Realtors settlement and the impact on home affordability. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. The Atlanta GDP Now forecast projects a healthy 2% growth as of August 16th. This is down from the 2.9% reported last week. Next, each week we look at the initial claims for unemployment insurance to gauge into the front end of the labor market. Initial claims for unemployment fell by 2.9% or 6,000 to 227,000 total, while continuing claims for unemployment also fell to 1.864 million. This week's next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week's rates remained relatively the same, with the 30-year and 15-year ending at 6.49% and 5.66% respectively, with only a 0.2% increase in both metrics. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull-to-bear spread raising from 3.09 last week to 13.65. Investors are increasingly bullish with the current market. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts, specifically watching for the September and future FOMC meetings. Currently, the CME Fed Watch tool is showing the market is leaning more towards expecting a 0.25% decrease in September. Once again, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 3.98%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 3.91%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 4.24%. So international stocks taking the win this week once again. That's 3 in a row. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Now on to point number 2. The Producer Price Index. The Producer Price Index for July 2024 revealed important trends in final demand and intermediate demand categories. In July 2024, the PPI for final demand saw a 0.1% increase, largely driven by a 0.6% rise in prices for final demand goods, offsetting a 0.2% decline in final demand services. Notably, this increase in final demand goods, the most significant since February, was primarily fueled by a 1.9% surge in final demand energy prices, with gasoline prices playing a substantial role. Conversely, final demand services experienced a decrease, primarily attributed to a 1.3% drop in trade service margins, particularly impacting machinery and wholesale. Aligned with the point number 3, the Consumer Price Index. In July of 2024, the Consumer Price Index data indicated a continuation of disinflationary trends in the U.S. economy. The headline CPI, reflecting overall inflation, rose by 2.9% year over year, marking the first instance of falling below 3% since March of 2021. This figure aligned with the average economist estimates and signified an improvement over the 3% rate observed in June. This positive development, particularly within the context of a weakening economy, strengthens the argument for the Federal Reserve to consider lowering interest rates. This suggests an underlook of the components of the CPI revealed a mixed but generally encouraging picture. The core CPI, excluding volatile food and energy prices, edged up by a mere 0.17% month over month in July, aligning with expectations. Notably, the 3-month trend for core CPI maintained its downward trajectory, reaching its lowest point since February of 2021. This suggests that the underlying inflationary pressures, excluding temporary fluctuations in energy and food prices, are steadily easing. Specific sectors, core good prices exhibited a significant decline in 0.3% month over month in July, marking the most substantial deflation since January. This deflation was particularly pronounced in used cars and trucks, although new vehicles and clothing also witnessed price reductions. This downward trend in core good prices is noteworthy, having reached its lowest point in over 2 decades. Conversely, core services excluding rent and real estate values saw a slight uptick of 0.2% month over month in July, rebounding from the declines observed in May and June. While this deflationary trend is evident, a point of concern lies in the housing sector. Shelter costs unexpectedly jumped by 0.4% in July, contrasting the 0.2% increase in June. And while contributing significantly to the overall CPI rise, this rise in shelter costs has attributed to a lag in reflecting actual real estate trends, potentially keeping the CPI reading artificially elevated. Despite the persistent housing inflation, the overall CPI slowdown in July is expected to bolster the Federal Reserve's confidence in implementing a rate cut in September. On to point number 4, the National Association of Realtors ruling and the impact on home affordability. New regulations from the National Association of Realtors, or the NAR, stemming from a $418 million antitrust settlement, will significantly alter the landscape of real estate transactions in the United States. These changes, effective August 17, 2024, aim to increase transparency and empower consumers in an industry often criticized by opaque practices. The most impactful shift involves the handling of realtor commissions. Historically, sellers bore the brunt of these fees, typically covering both seller and buyer fees. Under the new rules, sellers' agents can no longer publicly advertise their commission rates to buyers' agents on multiple listing services, or the MLS. This measure intends to curb the practice known as steering. Now, this is where buyers' agents, enticed by higher commission offers, might have prioritized certain listings over others. The new regulations also mandate that prospective buyers enter into a formal agreement with their real estate agent before house hunting. These agreements must explicitly state the agent's compensation structure, including whether or not the buyer or seller will cover their fees. While the long-term impact of these regulations on home affordability remains uncertain, experts predict that increased transparency and consumer awareness regarding realtor commissions could eventually lead to downward pressures on these fees, ultimately benefiting buyers and fostering a more competitive real estate market. However, short-term affordability concerns might be more influenced by fluctuating mortgage rates than these recent rule changes. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners all across our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below and schedule a meeting. Thank you again for watching. We look forward to seeing you next week.